My name is Jason Bordoff. I'm a professor at Columbia School of International Public Affairs and direct the Center on Global Energy Policy there. I appreciate everyone turning out today on what's a pretty nasty day. I know we have a lot of people, probably more than usual given the weather, watching online as well, because this is a pretty timely conversation to be having, especially on short notice. Appreciate everyone's coming out for this event. What we did last week in the midst of all the conversation after Thanksgiving about what was happening in the oil markets and why, there was a lot of discussion about what that meant for the U.S. economy, and we put out a note, myself and Jim Stock, a former member of the Council of Economic Advisors, that's out on the table outside, and some other commentary as we kind of engaged in the discussion about this. But there was a lot of discussion about what it meant geopolitically, what it meant for some of the major oil producers. We've seen impacts on currency. We've seen questions raised around the ability for several of these governments to continue to meet budgetary obligations and social spending obligations, what it means for U.S. Diplomatic engagement with them, for the future of sanctions policy in some respects. And we wanted to quickly pull together a group of experts to have a conversation about this. And we really have a fantastic group of people that we've brought together today to do this. Unfortunately, Mona Sutphin, partner at Macro Advisory Partners and member of the Center's advisory board and former White House Deputy Chief of Staff, has fallen ill and is unable to be with us today. But Jan Stewart from Credit Suisse has kindly offered to step in her place. And in addition to Jan, starting toward the end of the table, Steve Sestanovich is a colleague of mine on the faculty at the School of International Public Affairs. He joined the faculty there in the fall of 2001 as professor of international diplomacy. He's the director of the International Fellows Program and the author most recently of Maximalist, America in the World from Truman to Obama, which if you're interested in understanding the different waves of engagement and retrenchment for U.S. foreign policy is a must read. He's held a number of government positions in the past, from 1997 to 2001, the position of ambassador at large and special advisor to the Secretary of State on the new independent states. And before joining the State Department was the vice president for Russia and Eurasian affairs at the Carnegie Endowment, before that at CSIS, and before that at the National Security Staff and the Policy Planning Staff at the State Department. Seated next to him is Adrian Lajous, a fellow at the Center on Global Energy Policy. This semester, chairman of the Oxford Institute for Energy Studies, the former CEO of Pemex, previously has held other academic posts, including at the Kennedy School, was a senior energy advisor at McKinsey for a period of time, and we've really been delighted to have him at Columbia this year. And then Helima Croft, seated next to Adrian, who, as of very recently, as of October, is managing director and chief commodity strategist of RBC Capital Markets. Before that, as many of you know, she was managing director, head of commodity research at Barclays Capital. Before that was at Lehman Brothers and has worked at the Council on Foreign Affairs and the CIA, and has spent a lot of time at the intersection of energy, finance, and geopolitics. And then Guillermo Mondino is managing director and head of emerging markets, economics, and strategy at Citi. Previously was head of emerging market strategy at Barclays, where he also held the role of head of Latin America research. Before that was at Lehman Brothers, and has also held several roles in the Ministry of the Economy in Argentina, as Secretary of Finance, of Economic Policy, and as Chief of the Cabinet of Advisors. He's had a lot of experience advising a number of countries in the emerging world, including as a consultant for the IMF, the World Bank, and the Inter-American Development Bank. And then, as I mentioned, Jan Stewart from Credit Suisse. So we are going to try to have sort of a conversation up here. I'm going to ask questions of different folks, but hopefully we get a dialogue going among everyone up here to really have a somewhat informal, but hopefully quite interesting conversation about what's happening in the oil market and what it means, and then open it up to questions from the audience. So maybe, Guillermo, if I could start with you. if you could talk a little bit, sort of provide, before we dive into specific countries, kind of a macro perspective on what your views are maybe on what has driven the price decline, but more importantly, what you see it doing to the economy in some of these emerging market regions, to the global economy, and how you think about the impact on currencies and some other things.
Okay, great, thank you. Thank you for the invitation to be here. And so as to the drivers behind this recent move in oil prices, I think it's a combination of some demand factors, but mostly supply side factors. On the demand side, relatively softer global growth, particularly concentrated in softer growth in China, has been playing a role in softening commodity markets in general and oil markets in particular. However, the drop in oil prices has been so concentrated in a relatively short period of time, because remember, the first semester of this year, average oil prices for Brent were around 105. And we've seen a major collapse of prices from 105 to 66, 67 right now in a period of just 4 or 5 months. And to see such a big drop in oil prices, it normally is the response to some disruption or some major innovation that takes place on the supply side of that market. And we think that a big part of this story has to do with some geopolitical considerations, and but very importantly is the rediscovery by some players within OPEC, particularly the Saudis, of the importance of shale, the revolution that shale is bringing to markets, the growth in supply that is methodical, rapid, continued in supply of oil at a time when demand is really not there and is quite soft and not growing at the pace that it used to. And it's the fact that they are coming to terms with this notion that that oil is likely to be in permanently abundant supply that is bringing a response in the form of lower oil prices. The second important consideration here is, I think there is a fundamental change that we need to understand in the way that oil markets work, as the power of OPEC is being diluted. OPEC is smaller in relative terms relative to total global oil supply, and importantly within that, at least in my opinion, it's not just that it is smaller in relative terms, but it's much more fragmented with very different agendas within OPEC, with very different economic factors driving decisions in OPEC, with some countries in desperate need for defending, for introducing production quotas, and in particular defending revenues from oil, and some countries with a much more comfortable position that they can actually withstand the lower oil prices, and therefore can actually play this game out, if you'd rather call it a game. Now, in terms of the impact of this, as any oil shock that is originated on the supply side of the economy, it'll have a major impact on the demand side. Now, this is an oil shock that, for you to sort of get your arms around, is quite sizable in terms of the global economy. You can sort of come up with a rough estimate. It's very difficult to do these numbers right, but if you think that oil prices, take this scenario where oil prices average out in 2015, $80 for Brent instead of the current 66. So significantly higher than today, but let's just run with that example and assume that oil prices are at $80 on average next year, compared to the 105 that we had on average for the period maybe 2012 through half of 2014. That is equivalent to boost to global redistribution of income in global GDP of about 1.1% of global GDP. Now, this is a major, major shift of income from a group of countries. It's very focalized in a small group of countries, and it's distributed broadly across the world economy. It's a 1.1 redistribution from producers to consumers. this 1.1% of global GDP, right? So roughly speaking, it's 900 billion to $1 trillion of redistribution if we take $80 as the target. If you lower that to 70, then you go above $1 trillion, and that, of course, it's a larger number. So this is a major redistribution of income, as I said. A major redistribution of income along those lines can have significant impacts on different economies. So let's take, for instance, the impact on the U.S. economy. This could result in a drop in gasoline prices of $1 for unleaded gasoline. $1 of lower prices for unleaded gasoline is equivalent to, roughly speaking, $1,000 in the pocket of every American household, additional $1,000 in 2015 in the pockets of an American household, or $100 billion of additional impulse to consumption, if you wish, for next year. Right? So this is a nice little boost to demand in the U.S. economy at a time when jobs are already going up and where incomes are going to be going up. So you're going to get in the U.S. economy probably a nice little boost to growth in the fourth quarter this year, and particularly the first quarter next year. And in the midst of the winter, you're getting this drop in oil prices. This is going to be a very welcome windfall for the U.S. consumer.
Sorry, can you put a number on nice little boost? What?
A nice little boost, say $1,000 in the pocket of an American household at the time of Christmas shopping, it's annual $1,000, right? But people will spend ahead, right?
So the GDP growth rate, do you guys have an estimate?
Well, for the U.S., this could turn out to be an additional growth in the first 2 quarters of next year of roughly 0.4%, 0.5%, right? So it's a nice boost there. Now, this is a one-off thing, right? It's not that the U.S. now is going to permanently grow at that rate, but in the first 2 quarters of next year, fourth quarter through end of second quarter, you're going to see GDP growing a little bit faster than you would have thought. Similarly, for Japan, this is equivalent to, roughly speaking, another 0.5 percentage point growth next year. So we're now thinking Japan could grow next year at 1.7%. Now, Japan's potential rate of growth for us is about 0.7. So Japan next year is finally closing its output gap, if it had any, moving up to growing faster than potential and therefore having the potential of actually increasing a little bit of inflation. In Europe, we think that this could actually translate into another 0.5 percentage point of additional growth next year. And therefore, Europe could be growing at 1.3%, 1.2%, 1.3% next year. So the advanced world will get a boost to growth that emerges from this side. China, another beneficiary, a big beneficiary of this impact. Now, China is a little bit more diluted. It's a little bit more difficult to play these games because this obviously has a big impact on Chinese trade accounts. And in China, we estimate that the impact on just the one-off impact of oil prices on the Chinese trade accounts could improve by about 0.7% of GDP. So if Chinese trade surplus was explaining in 2014 about 2.5% of growth, with this you could go up to, say, 3.2% of growth, just coming from the fact that you're going to have this lower oil prices. So this could actually be a major source of relief at a time when China is slowing down. But then again, the question is in China, is this going to be translating into lower fuel prices for the consumer? Is this going to play out the way that it does in the US, eventually in Europe or Japan? And the answer is probably not exactly the same, probably won't have the same type of multiplier effects that it has in these countries, but it will be positive. It'll help out on that account. Korea, another story where we're going to get a nice positive impulse in growth. Maybe in Korea you get a 1%, maybe as high as 1.2% boost to growth there. So there's a number of countries that stand up to win big from this. The problem is on the other side, and these are countries where the benefits are somewhat diluted, right? Because you could argue that in the U.S., the oil producers are going to suffer, but the oil producers in the U.S. tend to be corporations, and therefore their share prices are going to come down, and the value of their debt is going to go down, And therefore, the holders of those equities and the holders of those bonds are going to suffer somewhat, but that is highly concentrated in wealthy individuals, and therefore the impact on consumption is going to be minimal. But if you're Venezuela, if you are Nigeria, if you are Algeria, if you are one of the Arab countries, you are critically dependent on oil prices to support government spending. You're critically dependent on oil prices to support your balance of payments and the source of dollars for that economy. You're critically dependent on oil prices to support economic activity in those economies. And you could see in those countries a concentration of the pain that is beyond belief. So we could run the same type of exercises we did for some of the advanced economies, and you could come with numbers where Venezuela faces a contraction in non-oil in consumption and some of the sectors of 5 or 6% of GDP, right? It's a level of pain that is unbearable for a country that's already been going through a lot of pain for the last few years, right? Similar exercises you could run for a number of these other countries, and the level of pain is also is major. So you could have, in the Arab countries, you could have contractions in the trade surpluses of 8-10% of GDP. Now, when your trade surplus is contracting by 8 or 10% of GDP, something has to give on the other side, and you need to absorb that. In Russia, we're estimating 2.5% of GDP contraction as a result of the oil shock, leave alone the sanctions, right? So this is a very concentrated pain in a number of countries. So if you compare a boost to GDP in the US, in Japan, in Europe of maybe 0.5% against contractions in these oil exporting countries, the distributional considerations become very, very important. Now, it's nice to be on the receiving end of that, and it's pretty nasty to be on the other end. Now, being on the other end, of course, will generate a lot of geopolitical issues. And I'm not going to opine on geopolitical issues. I have experts that know far more than I do. But just think about what it is, what it means to be in a country that all of a sudden needs to produce a major adjustment to absorb a blow of, say, 2.5 to 8% of GDP, as might be sort of a reasonable range for several of these countries, right? And that is a major external shock that is very difficult to absorb, and it stresses any political system that you might have. So we are set up for a very interesting 2015, where I think more than the economics, the geopolitics will be in the driving seat.
That's a great overview. Thank you. And so let's talk about what some of that means. Helima, first, do you agree with the amount of pain that we see some of the losers bearing, and what does it mean for stability in some of these countries?
That was just an excellent overview, so I'm very happy to go after Guillermo. But I think it absolutely, and I think it's a pain distribution. I certainly think that if you look at a country like Kuwait, I almost put them on like the far end of a spectrum, where you have 4 million people, 1 million of whom are Kuwaitis, a $548 billion sovereign fund. You have a situation whereby Middle Eastern standards, they do have a parliament. I mean, you still have a monarchy there, but it's a bit softer politically in terms of controls over people's everyday movements. They have more political openness. So I think they're better placed. But then on the opposite end of the spectrum, and Guillermo mentioned Venezuela, but I would also just put Nigeria in that camp, absolutely. And they're the ones I'm most concerned about. If there was like a clear and present danger of a country that can ill afford to have this type of revenue shock at this moment, it would be Nigeria. And in September, I was at a conference organized, in DC on Nigeria, and we were talking about scenarios because they're going into an election, which is going to be very polarized on regional and religious lines. And we were saying, gosh, what would be a terrible situation would be if the Saudis don't defend any floor and we're in an $80 Brent price environment going into a February election. And now you sort of fast forward to where we are now. None of us anticipated looking at a Nigerian election in February in the sort of $60 Brent price environment. And if you think about Nigeria, it's Africa's largest country, 200 million people. They've had a horrible civil war. They've had coups in low price environments. And we're in a situation where the country is very, very fractured. You have an insurgency in the north. You have a government that's seen as Christian, Southern. Many Northerners oppose that. A lot of weapons have gone into the country. And the way that elite would hold themselves together was with oil revenue. It was literally the glue that held the patronage machine of Nigeria together. And they had this nice little mechanism for doing their budget. It was called the excess crude account. And everything above $77 was basically went into a separate account that you used at the discretion of the presidency to keep your military happy, to keep your various state governors happy. And that account stood at about $22 billion in 2008. The finance minister, who's pretty highly regarded, she came out, a couple of weeks ago and said by the end of December, if there's no correction in oil prices, that account will be eliminated. So we're looking at a situation where their excess crude account now is basically gone going into an election. They had $38 billion in foreign reserves. $2 billion have basically come out in the last couple of weeks. And so that is a country I think everybody has to be very concerned about because they're having this oil price retrenchment and an election. The election was always going to be a rough election in Nigeria. Without money, it's more concerning what stability will look like. And that's important just for externalities because, again, it is the most populous African country. It's a big counterterrorism concern for the United States. So that's one I'm just watching very closely. And I think about Saudi Arabia, believe it or not, given the size of their reserves, you would think I would put them over in the Kuwait camp. But I always say about Saudi Arabia, they're the biggest GCC country. They're 29 million people. That money does not go as far. And I think about the bargain that Saudi Arabia made with this population after the Arab Spring, when Hosni Mubarak was thrown out of power in Egypt, Ben Ali in Tunisia. They doubled down on that bargain. Don't go into the streets. Don't ask for major political and social change, but we'll take care of you from cradle to grave. And that was a very expensive bargain to strike with their population, whether it be the $130 billion in new domestic spending, but they also massively ramped up spending on the military side. So one of the reasons why we have a higher budget break even for Saudi than some banks is we look at the defense spending. We've just seen this massive, massive run up in Saudi defense spending post-Arab Spring, but also the money that they give to other countries. They give substantial financial support to countries like Egypt. They're one of the big bankrollers of the military regime there. They give substantial financial support to Jordan, Bahrain. And so we look at Saudi Arabia and we say, at a minimum, they're going to have to be running a deficit. And the question is, in this type of environment, with the Middle East being this restive, are they going to have to start cutting foreign aid to certain countries? What does that mean for stability in places like Egypt? But also, what does it mean for internal stability? So I would actually put Saudi somewhere in the middle when we talk about a spectrum of pain. Certainly, they're not in the Nigeria situation or the Venezuela situation, but I don't think this price retrenchment is by any means pain-free, and cutting spending comes with political risks there as well.
Guillermo, just to follow up on that, what does it do to the Saudi economy, currency, if they have to go very deeply into their reserves to meet all the obligations Helima was just talking about?
Well, the Saudis have what it takes to survive with low oil prices. They do have a huge sovereign wealth fund that they can resort to. However, with oil at these levels, obviously the country stops running a current account surplus, will now have a large budget deficit. And under normal circumstances, you would see a currency that starts depreciating rapidly. We've seen something like that in places like Russia. And we would normally see that pressure building in the Arab world. Now, if you don't allow that flexibility in the system, then what you end up having is transferring the burden of the adjustment entirely to the demand side. You need to compress the demand side more. So you're going to have a lot of internal issues because they're going to have a tough time adjusting the budget eventually. But I think that for the next year or two, the Saudis will pull through. I don't think this is an issue for them. They have their own they have a lot of internal political issues, right, that go from this bargain that Lena was talking about with the population to support the population. But they have their own internal palace politics that they have to address and they have to resolve, succession issues, so to speak. And so all of those are a lot harder to do when you have oil prices at these extraordinarily low levels. My impression is that the Saudis will withstand this. They will at some point come back and defend the oil prices. but we may not be quite there yet. So that's why I think it makes some sense to work on their assumptions that on average oil prices next year will be higher than what we have today, because at some point a lot of these countries will be brought back to try to defend prices and reduce production. But still, the impact is going to be major. We're going to see large adjustments in a number of these countries. So I'd rather not go into too much details on the Saudis, first because I don't know much about them, but second, because I think this is a country, the Saudis, Kuwait, and the Emirates are the three parts of the world where one looks at, one has a sense that these are the guys that are much better prepared to go through this episode. And they may not be, they may in the end be the ones that actually help put a bottom on the market. But my concern, as Alina said, it has to do with the weaker part of OPEC and the weaker part of the oil-producing world.
So let's walk through some of the countries that you laid out. But just one question before we do. I mean, part of this question of how much pain and how much challenge they face is how long prices stay at 60 versus 70, 80, or 90. It's always a difficult, tricky thing to predict. But Jan, how should we think about how much pain these countries might need to endure and for what period of time?
You know what, I'll answer that question, but I'll also get to answer the GCC question, right? Because I'm afraid I don't really agree with you on that one. So how does price correct? We're afraid that our friends in the GCC basically walked away from this. I think David Knapp's group had a brilliant headline when they said, OPEC to market, go stabilize yourself. So that's going to take a little while, we think, because the go stabilizing yourself process involves here in this country the better part of, anywhere between 100 and 1,000, some publicly traded entities, but mostly individual entities with capital and shareholders that are in the business of growing production. Everyone that knows the slightest little bit about the E&P universe knows that these guys are in the business of growing production. And they have found an absolutely brilliant way for doing that, right? The Permian, we think, is only in the beginning of production growth. The Bakken has maybe run most of its acceleration already. The Eagle Ford is in the sweet spot of growing. So now we're going to have to persuade 1,000+ guys and management teams, all of whom know that if they are the first ones to take money off the table, they're going to get fired, right? But each one of these thousands has to be persuaded to slow things down, right? In the absence of sovereign action, we think it comes down to the industry bottling up the animal spirits, so to speak, of production growth here in America. And while we can do sensitivity analyses, well-by-well exercises with type curves and money to spend, so what we do is we figure out what is the cash flow into the industry, what is the access to debt markets, what is the offset from hedging, what will be available to drill. Then we figure out where will they likely drill and what then will be the resultant growth once we assume massive contraction in cash flow and money to drill. In some such world, in theory, should all of these guys behave rationally, we can reduce growth here in America, black oil production growth that was 1.2 million barrels a day and change this year, to something sub 200,000 barrels a day and solve the global oil balance next year, right? Problem is that not everybody is going to behave rationally from day one forward. So how do you adjust for that? We think that by the second quarter, all else equal, we're going to see the beginnings of change. And that's when the market can then begin to triangulate, well, what will that change involve? When will we rebalance? And again, all else equal, at what point do we think that these global oil supply demand balances begin to look less in surplus? How can we get back up to an average annual price that is a little bit higher next year than where we end 2014. It's a very, very messy, protracted process that we have to work through.
If that headline is right, OPEC's telling the market, go balance yourself, the bulk of that balancing is going to be done by U.S. shale, in your view. That
is what is the most sensitive to price in the shorter run. I mean, it is no longer probably a great idea to sink a massive integrated oil project into the Canadian oil sands. But even if they took that money off the table, you wouldn't see the result of that for another 20, sorry, I'm being nasty, not 20 years, but another 4 or 5 years, right? Here in America, the new production involves decisions that you make every 22 to 30 days for drilling the next well. Right? We drill and complete something like 16,000 wells now in this country that all produce oil, new ones. Right? So by drilling fewer of them, because there's less money around, we can reduce the rate of growth. We can do that in a scale that matters globally, really only in this country.
And so the takeaway from what you said, if we're going to do the balancing and people may not be behaving totally economically rationally for some reasons, is we still have a ways to go on the downside.
Yep.
So what does that mean? So that's even a different. That's even more pain for some of the countries that we were just talking about. One of those countries is Russia. We have someone with us who knows a little bit about Russia, Professor Sestanovich. Can you, from your standpoint, talk about what you think, what you just heard, a sustained price decline means for Russia, for their budget, and how this drop in revenue interacts with all the other issues that Russia is facing, including sanctions, the drop in the ruble, and the other ways in which the economy is struggling?
I liked Guillermo's phrase, places like Russia. Those of us who study Russia think there are no places like Russia. A little context here, a little perspective, because it's related to the denial that some Russians still experience in responding to this. They remember that when they hear the Russian central bank is now predicting a kind of 2% drop in GDP. They recall that in 08-09, the drop was 8 to 10, the biggest drop from previous year growth to crisis decline of any country in the G20, and they think, well, maybe there'll be a quick rebound this time too. That's the hope that you hear commonly. And there are some bases for thinking that. Russia is not a particularly indebted country. They've got significant foreign exchange reserves. So maybe the adjustment doesn't have to be too hard for them, even though there's a big hit to revenues in the short term. $100 billion from the decline that we've seen so far. But what complicates this for Russia right now is the way this oil price decline interacts with sanctions. Because Russia is right now, this is, I think, an important point to understand in judging their response to it. They're not fully integrated into the international financial system. And the drying up of credit as a result of sanctions is pretty dramatic, more than they expected a few months ago, more than Western governments expected a few months ago. It turns out that you don't even really need coordinated US-EU sanctions on banking and credit. You get a tremendous response in the EU just from American sanctions. And so you've got companies that are in refinancing trouble. Over the next year, the kind of typical standard number, I don't pretend to have researched this myself, is $130, $135 billion in refinancing needs. Already banks are turning to the state for funds to bail them out. 15 billion here, 30 billion there. It puts some light on the Russian central bank's decision not to support the ruble. In 08-09, the Russian central bank, in not very long period of time, spent $150, $200 billion to keep the ruble roughly in the mid-30s. I'm remembering this a little vaguely. This time they've done much less. They announced they were going to, curtail their support early, and that's understandable, seeing the other demands on state resources that they face, given the double impact of the oil price drop and sanctions. I think we have to. And this may be true. I'm no expert on any of the other countries that we're talking about here, but Russian kind of separation from the international financial system seems to me, a serious complication. You have a set of other internal pressures that I'll just allude to very briefly on the state budget. And you saw evidence of that in Putin's State of the Nation speech last week, which was full of ranting about inefficiency and waste and the need to tighten up and impose more discipline. These saying you cannot have a state bureaucracy that just is constantly inspecting companies. What this means is extorting bribes. He didn't use the word corruption in the speech, but the speech is shot through with concern about corruption. Ranting about cost overruns in the defense budget. Some projects have an 11-fold overrun in cost. A sort of hint that there will be that the government will not be able to push through the kind of defense increase that it expected this year. All of this is against the backdrop of very significant, sustained, and so far not yet threatened personal popularity of Putin as a result of his kind of, the nationalist hysteria that he has created. What nobody knows is how durable that is in economic hard times.
And so can you talk a little bit about what that means for sanctions are there for a reason with some of the behavior that we've seen the Kremlin take recently. So do you think this increases the leverage that Europe and the U.S. have to see a change in the Ukraine confrontation? Do you think it increases the likelihood that we'll see a sharp shift in behavior?
Well, it somewhat increases it, but does it increase it enough? We don't know. I think you have to say it certainly increases the leverage that Europeans have, because European governments and the United States have, because this period is suddenly more painful to the Russians than they expected. In addition, you've got an extra factor here, which is not an economic one, and that is the bitterness and alienation of some of the most important European governments in dealing with Putin, because their view is not lived up to any agreement that he's offered them to wind down the Ukraine confrontation. Their feeling is they've offered a lot of off-ramps, and Putin has never responded fully to them, never lived up to what he said he was going to do. And that means that in addition to the Europeans having more leverage, they're demanding more in the way of performance. They're not so interested just in more kind of limping along ceasefires that don't get observed while Ukraine disintegrates. Merkel's position is now generally described as one demanding a real resolution of the problem, real end of Russian interference, and that's a big threat to Putin, because it means he's got to ask himself whether his popularity can sustain what will look like a significant pullback. But all the same, and as reluctant as he has been to disengage, I think you'd have to say there were some hints, for all the belligerent rhetoric in his State of the Nation speech last week. There were some hints of a desire to keep this, to wind down this confrontation. He talked very little about Eastern Ukraine. The big nationalist cheerleading was all about Crimea. He has said a number of things in the past couple of days, including in his meeting with President Hollande over the weekend, about respecting the territorial integrity of Ukraine. He even said in the State of the Nation speech, we respect Ukraine's right to choose its allies. So there are hints of which make a lot of sense, of a Russian desire to disengage. The problem that both Washington and European capitals feel is you can't really count on Putin to do what he says, and that means a much more difficult negotiation in which people aren't looking, in which governments are not looking just for Putin to make a good faith gesture. They are looking for some resolution of the conflict.
There are so many other countries to talk about. Let me stay on Russia for just one more minute since we have you here. So some, notwithstanding the recent deal, some are still concerned about a gas crisis materializing this winter in Ukraine. Are you worried about that? And does this change the likelihood of that in any way?
Well, you know, I think among signs of a return to normalcy, the deal to continue gas deliveries to Ukraine through the winter was a sign that Putin does not want to have a big crisis there. He could say between now and the end of March, when which is the extent of the deal reached with Ukraine, that the Ukrainians are not living up to it and he's going to have to cut it off. But that would be yet another kind of poke in the eye of European governments. I think that is actually now an even more explosive step for Putin to take, not to mention the impact that it would have on anxiety about deliveries to the rest of Europe, because those are two separate things. So my gut would be, but I've been wrong on Ukraine through most of the year. I need to advise you on this. I've been thinking that Putin would do the sensible thing. And he's steadily not done the sensible thing. I would say this is one extra fight that Putin does not want to have.
What was your take on the South Stream announcement? And is it really done, or was that sort of some sort of negotiating play? Yeah, please, sure.
Yeah. The Ukraine.
Yeah.
In the end, the Ukraine's fate is on this gas issue, and several of the Ukraine's financial problems will be decided in Washington and Brussels, right? So, in the end, the biggest problem, I think, is I go along with this idea that Putin probably doesn't want to poke the Europeans in the eye again, and therefore he'll live up to the agreements if he can get some cash out of this. So the entire point is, will the Ukraine be willing to pay up front for the gas, and will they deliver and pay up front for the gas, and more importantly, will the Ukraine keep paying and eventually pay the Russian bond next year, right? And that's a decision it's up to Washington to make.
Because they're paying.
Right, they're paying, right?
Right?
So they're paying. So what's it going to be? I think that eventually Washington and Brussels will dish out the dough. The Ukrainians will keep on paying for the gas. Nobody wants to have this episode sort of explode in their face. And if the Ukrainians were to stop payments to the Russians, then the Russians would have another excuse to make this. So we're back in the land of real politics on this. And I think these are peanuts for Washington in the end. Compared to all the other issues that they have in front of them, this is something that they'll probably take care of.
I should add one thing. Because you're absolutely right that paying Ukraine's gas bill is peanuts for the US and EU, and they'll do it primarily through the IMF. But the overall question of support for Ukraine is not peanuts. It's a larger amount, and the question of how firm the support is of Western governments for Ukraine depends a lot on what happens in Ukraine. It isn't just Putin. Is there a government that looks as though it's able to act in a coherent and effective and purposeful way? Never a sure bet in Ukraine. South Stream, just a word about that. I would say this is a really significant hit for Putin. He has spent the year in a kind of shoving match with the EU and its various commissioners on energy and competitiveness and trade and so forth, challenging them by essentially trying to buy off different members of East European governments, from Austria to Hungary to Bulgaria, and even non-member governments, Serbia, and it's failed. And that, there has been a pretty significant EU resolve here not to let its members get away with freelancing on major energy projects like this, and Putin had to look at the question of how long is he prepared to sink money into a project that was ultimately going to go down. So I would say it's a pretty big setback, and one that's related to the things we've been talking about here. This is a vanity project in part for Putin. I mean, he's personally associated with it, and the personal humiliation is significant to have to do it, and you have to balance that against the cost. I don't know how many ways he's got of rebounding after this, but he may be kind of out of string. You can encourage the Turks to buy more Russian gas, but I'm not sure that's going to save South Stream.
Adrian, Lajous, I want to ask you to respond a little bit to what you've heard so far broadly about the impacts in the market, winners and losers, and then in particular to offer your thoughts on Mexico, which is undertaking very ambitious and historic energy reforms, trying to attract a lot of capital, including into some high-cost production areas. And how does this change the outlook over there?
Well, I think Mexico provides a counterexample to the descriptions you have made of various countries that have been made about various countries on this table. The impact of lower oil prices obviously affects Mexico, as it does any other large producer and exporter of crude oil. And in the case of Mexico, since let's say from the average price this summer in the month of July to today, the price of the average Mexican oil export mix has dropped by 44%. So it is important, but at the same time, what I would like to stress is that Mexico is relatively well protected from this fall in prices. It is well protected, first of all, because of structural reasons. The oil industry in Mexico, it's a much more diversified economy than that of any other major oil producer and exporter. In terms of GDP, the oil industry only contributes to about 6% of GDP. If you look at the balance of trade, oil exports today, well, in the first half of this year, to eliminate the recent effects, it was 12% of total merchandise exports. So it's not really important in terms of the trade of trade. And finally, where it is important, it has to do with public finances. Close to 31% of the government's revenues come from the oil industry. So that's, I think, where Mexico is a bit more vulnerable, and clearly that's where it hurts most. Now, having said all of this, these are the, let's say, more structural aspects. In terms of the specific juncture in which we are, the Mexican government has been executing a very large hedging program. And this hedging program essentially covers a large part of the government's revenues. So the impact, at least for 2015, also in terms of public finance, are, I think, important. Now, notwithstanding all of this, if you look at the Mexico City newspapers this morning, they will tell you that what's been happening to the exchange rate has to do with what's happening to the oil price. And I don't agree. I think that there are other much more important determinants, and these are the sequential downward revisions of GDP growth that have been made throughout the year, irrespective of the oil price. Very serious allegations of impropriety by the political elite in Mexico, and very serious security issues. I think this is what is really affecting the confidence of the private sector, and that it's being reflected in terms of the exchange rate, which has depreciated over the last 3 months by about 8.7%. But I would argue that it's not really the price of oil, it's other things that are coincidental with the fall in price that are really affecting this. Now, Jason sort of posed the question with respect to Mexico in relation to the opening up of the Mexican upstream to international investment. And there's no doubt that Mexico at the present is under a lot of pressure to offer a number of concessions in terms of the bidding process that will be invitations to bid will be out this week. So, there's a lot of pressure to, before the actual contractual forms come out, to make some concessions on them. And I think that the Mexican government should resist this. It should resist this because the structure of cost of the assets that is going to be putting up for bid can sustain the current level of prices, are consistent with the current level of prices. I think they are attractive at the current level of prices and probably even lower. But at the same time, we have to be clear that investment decisions, final investment decisions, are not made on the basis of tomorrow's price, but on the basis of longer-term prices. So in that sense, I think that Mexico would be prudent in resisting these pressures. Every single oil company, I'm sure, is visiting with the Mexican government and telling them that there's going to be enormous competition for capital, that people have to be very responsible to their shareholders and that have to exercise extraordinary financial discipline. And I have no doubt that that's the case. But I don't think that it really affects the prospects of a successful bid in Mexico, given the quality of the resources that are being put up to bid. Now, I do believe that in spite of all of this, Mexico would be well served, and that might, you might find it paradoxical, but I think that Mexico should be prepared to join other producers in trying to stabilize prices. It will come up, it will be in the agenda for the year 2015. In the past, Mexico has coordinated its actions with OPEC. It has played an active role in terms of various forms of collective action, and I think that it should be prepared to do so again. Now, it has an instrument, which is the state oil company, which will continue to be the dominant producer in Mexico for a number of years to come. So in that sense, I think it's in its interest, and it has the instruments to carry out some form of coordination with other producing countries. Now, finally, in all of the discussion, there's a lot of implicit views about the future of prices. And I must say that I really have become more and more worried, sorry for the pronunciation, regarding price forecasting. I admire the analysis that many people produce regarding the market, but I am a bit tired of all of these price forecasts. I don't think it is possible to have any idea about what will be the further rate of decline of prices, for how long they will remain low, and then how and if they recover. I think it's just one more expression of human folly, this sort of desire to have a price forecast. And let me tell you a little story. In one of my previous lives, I had to produce regularly oil price forecasts for the Mexican government. And so I did that for many years. But at one moment, one of my political masters was asking for new forecasts very often, in a month, 3-4 forecasts. So in a crazy act of arrogance on my part, I told him, look, I now know, instead of giving you a new forecast, which was my obligation, I was being paid for it, instead of giving me one new forecast, let me give you a rule, which I had learned from a very wise Exxon planner. And that was, whenever you feel the need for a new forecast, take the average of the last year and forecast it forward. And I assure you that you will not be better or worse off than by asking me for a forecast. We really don't know. And in that sense, I think we should be very careful in making strong statements about what's going to happen to all of these oil-producing countries and to the world economy because of the price of oil.
We don't know, but obviously lots of people in industry and elsewhere have to make some pretty consequential spending decisions based on their best guess. So it's probably not going to go away anytime soon, forecasting.
I'm sorry, investment decisions are not made on the basis of short-term price fluctuations.
Let me quickly, before we open up, just touch on Helima or anyone else on Iran and sanctions. Does this, in your view, increase Western leverage, change the outcome for some resolution in the P5+1?
Well, actually, one of the things I'm sort of thinking about in terms of Iran going forward is that we've seen the Iranian government, be willing to deal with incredible economic pain in pursuit of saying that they will have threshold nuclear capabilities. I mean, people kept saying for the last 5 years that at some point the Iranian government is just going to fold in terms of their concessions in order to get financial relief. And so I'm wary of saying we're at the moment now where the supreme leader just says, you know what, I don't need to have significant numbers of centrifuges, which seems to be one of the sticking points because of this oil price decline. What I'm actually most concerned about is what the U.S. Congress will do, because I do think that the switch over to having the Senate in particular being controlled by Republicans does move up the chances of some of those bills that have already passed the House of Representatives, which would significantly tighten the sanctions noose on Iran. There's this one bill, the Menendez-Kirk bill, which would essentially, say if Iran does not give up its entire domestic enrichment program, importing countries have to make further reductions in Iranian crude imports. I think that kind of bill gets to be seen as pain-free in this type of environment. In a low-price environment, I think all sorts of political calculations can be like, well, it doesn't matter if you turn up the sanctions noose on Iran and potentially take more Iranian barrels off the market, because you know what? We're in a low-price environment. And so I actually do think that there is this risk that's underappreciated at the moment, that some of this legislation to tighten these sanctions will potentially pass the Senate. It's already passed the House of Representatives, and that sets up a confrontation with the White House. And whether the Democrats who signed on to a version of the bill earlier stick with it or whether they stick with the White House. But I think rolling the negotiations over to July potentially gets seen as sort of a road to nowhere. And so I think there is this sort of risk that's not being appreciated right now, that you could get additional sanctions, which could have implications for the negotiations. But one thing the Iranians at least have going for them right now is, as long as the sanctions, the talks continue, they do get incremental sanctions relief. Between now and July 1, they'll get about an additional $4 billion in access to their frozen accounts. So do I think that they're about to fold because of this? No.
And do you think it changes the potential for cooperation. Iraq KRG was how much of a factor was the decline?
I would go back to 2009 because the last time we had a sort of breakthrough between Baghdad and KRG was also driven by revenue. We had a situation where oil prices obviously collapsed 2008, 2009, and the Maliki government was having problems paying their security forces. And Maliki had insisted that the KRG contracts were illegal. But he decided to pay the operators of the Tok and Takwe fields and essentially say, we'll cover the cost of the producers, and KRG, you can continue to get 17% of your budget allocation, even though we say the contracts are illegal. Now, as soon as prices recovered, Maliki was like, I'm done with that. You know what? Those contracts are illegal. If you want to pay them KRG, pay them out of your 17%. Now, there's a lot of enthusiasm about the new Iraqi government. People are saying turning over a new leaf. They want cooperation more long-term with KRG. The only thing I would say about that deal is, A, it has to be ratified by Parliament. A part of it also is that the Iraqi government will pay the Peshmerga security forces. That could sort of evaporate, or the payments could be erratic. Also, if you did have oil prices rebound, I think there is a risk potentially that that deal gets scuttled as well. We haven't had the full formal recognition of the KRG contracting process. I think this is driven, again, by revenue imperative. So you do run the risk in any environment like that where basically it evaporates once you don't need to have that money.
Let's open it up and we have questions. We have, in addition to everyone you guys are looking at right here, about 250 people, I'm told, watching online. And those people can also submit questions through Twitter at Columbia U Energy with the hashtag CGEP, Center Global Energy Policy, CGEP events. We have a microphone, I assume, yep, over here, 2 microphones. So if anyone has questions, please raise your hand and identify yourself and ask a brief question. Thank you.
Thank you. I'm Craig Hauser, and I'm curious about the Russian sanctions against the West, in particular the vegetables and fruit limits at the border. It seemed like it's had an effect greater on Russia than on Eastern Europe. And is it something that kind of backfired in Putin's revenge against the Western sanctions?
Does anyone have any thoughts on that?
Yeah, I think you've got it exactly right. Russians jokingly talk about Moscow now as the brie-free zone. And, imported cheese nowhere to be found. I think in general it has, it's just added to food inflation, which has now become pretty significant in big Russian cities. Russians have, over the past 20 years, imported a huge portion of food. Putin said in his State of the Nation that this is going to be great for Russian agriculture because one of the themes of his speech was import substitution and finding ways to take advantage of these sanctions will be great for Russian agriculture. Russian agriculture has rebounded in things like grain production. They're not yet producing brie, and fruits and vegetables are still in many cases import items. So this measure has put a little bit of a dent in some East European in the exports of some countries on Russia's periphery, but it has not become the significant factor in the shoving match between Russia and the EU that Putin hoped it would be.
Any other questions? I can ask lots more, but yeah, there's one over here, and then we'll go up to the 2 in the front.
Mr. Stewart, my name is Vincent Brancato. Mr. Stewart implied there would be a reduction of about 80% in new shale oil production next year in the States and a reduction probably of new tar sands activity. So is this drop in oil prices the beginning of a ground to bring to the climate change conference coming a year from now in Paris? I've heard no discussion at all of the climate change problem facing us from any of the panelists. And I'm curious if there's any view that the oil price change or the total situation of the industry should face this differently.
Go ahead, yeah.
But there is one way in which climate change, in a sort of backward way, does enter the discussion, because it comes back to why did the Saudis do what they did, right? Why did the Saudis really abdicate the swing producer role? Why did they allow for prices to collapse in the way that they're now doing? This is not, news to the Saudis, that losing control of an oil market provokes very, very, very low prices, right? And the popular narrative of the Saudis wanting to put a hurt on Iran, as per Helima, is hokum in any language. No, I said that you explained the Iran problem properly, and the popular narrative, the popular narrative is that somehow the Saudis wanted to put a hurt on Iran, right? And that's complete hokum. What the Saudis really, my humble opinion, may have been after is dealing with a world in which there is much lower demand growth going forward for their crude. And part of the reason for why there would be much lower demand going forward is that just about every consuming country has become more and more worried about climate change. We are in a policy-driven world writing policies that are not exactly promoting of producing, stimulating the consumption of oil, right? And the Saudis, in perhaps their own way, are possibly dealing with a world in which there is simply going to be much less growth going forward, in part, like I said, because of what the consuming countries are doing in terms of dealing with worries about climate change.
Yeah, I mean, we can have a debate about demand elasticities, but at a lower price, you're going to expect more consumption, and that's an important reminder about the need for national policies in the U.S., where we've seen gradual declines, but then a recent tick up again in gasoline consumption. The need for continued, in my view, progress on heavy-duty fuel economy standards and other policies that we put in place here. It also, potentially, in my view, presents an opportunity for countries that want to scale back fossil fuel subsidies, which is both good for economies and also for consumption and emissions. A falling price environment may be a much better opportunity for some countries to take that step, and so I hope we might see some progress along those lines. Let's take. Yeah, we've seen some of that already, exactly, and this would add more pressure. There was a woman here, and then just behind David Knapp, and then. Yep.
Hi, my name is Heidi Skjeseth. I'm a Norwegian journalist. It's a follow-up, actually, on the climate question, because there are, as we know, climate negotiations happening right now in Lima, Peru, going forward to Paris next year. So I was just wondering if anybody could say if these low oil prices can affect the negotiations at all, or if a good agreement can affect oil prices, or if you can make a connection there. Thank you.
We have a lot of questions, so maybe we'll take two at a time and then get them in. There was one over here.
My name is Rostislav Taborský. I'm from Czech Ministry of Foreign Affairs. I have read an article that potential default of American producers of oil can have an impact on, let's say, junk bonds market. In consequences, it can influence the whole financial system. What do you think about this? What is your opinion about this? It's a real danger.
Thoughts on either of those?
I'm willing to take a crack at the impact of on the bond markets, on credit spreads and so on. It is clearly true that the largest issuers in the U.S. credit market, the largest sector issuing in the U.S. credit markets in the last 2 years has come from the energy side. And a good chunk of that happens to be sub-investment grade quality by a number of smaller oil companies. It is also clearly true that with oil prices where they are, the capacity of those companies to service this debt is more questionable. I would hesitate to jump from that to the conclusion that we're going to see significant stress building in the credit markets. I think we have there's a long way to go before we get to that. There will be some bonds that will be affected. There will be some companies that will be affected. but I imagine we'll see a much more active mergers and acquisitions market happening first before we see this having an across-the-board impact on the high-yield market. So the weaker companies being acquired by stronger companies that are maybe not as leveraged and not as affected. I think that is likely to be part of the results of this is a significant consolidation in the industry in the United States. So I would tend to argue that it is something that we look at. We've seen spreads widening. We see tensions building in some of these segments in the market already. But I think the market has its ways of addressing some of these issues. And I doubt that this turns into a junk bond crisis for the U.S. At least it's a little bit early to get to that.
So on the climate question, well, maybe in the same way that Adrian said, long-term investment decisions are not necessarily affected by very short-term fluctuations. I mean, we're thinking about very long-term agreements and long-term policies that get implemented over decades. But in terms of the impact it has on what's happening on the ground at any given moment, I think I'm going to put someone on the spot, and we're going to take one more question. And while we're doing that, I'm going to bring a microphone back to David Sandlow, who's a fellow at the Center on Global Energy Policy and has spent time thinking about the international climate agreements, and see if he has a comment on that. Do you want a minute to think while we take another question, since I put you on the spot?
Well, thinking can be dangerous. It's a great question, and I think in terms of the short-term impact in the negotiations down in Lima, I wouldn't look for big impacts. I think those negotiators are dealing with some pretty technical issues right now. But I think this will form part of the dialogue next year as we go into Paris. And there's going to be a lot of discussion about the directions in energy markets, and I think it'll be an important part of the dialogue.
There were more questions.
Talk about something that's long run. If investments in energy are not driven by economic forecasts of prices in the short term, imagine negotiations on these issues. That just the negotiations alone will take forever. I would tend to think that we're going to be driven by much more longer-term trends rather than having low oil prices. Though you can tell by the pickup in demand for F-150s that we saw in November that the consumer is very quick to abandon any wishes to go green, and the demand for Prius went down and the demand for the F-150s went up, right? So it's very clear.
Reminder of the importance of policy and why fuel economy standards will help, if not more direct price signals, will help drive changes in the transportation sector. Someone has a microphone here, and then David Knapp.
My name's Hao. I'm from Nomura Research Institute. I have a question about the U.S. E&P companies' hedging programs. Given to our research, we think most of the hedging program is going to run out in the first quarter next year. So I would ask the panelists, what's your thinking about how the hedging programs run out will affect the oil production?
David Knapp, Energy Intelligence Group. I wanted to follow up on one of the points that Jan made about the momentum in the U.S. shale. And my feeling is that we're paying maybe too much attention to the, let's call it tight oil, to be inclusive. There is some more vulnerable supply around, even in the U.S. And we have an example back in the late 90s when there was a decline in oil prices. What got shut in were stripper wells in the U.S., very low productivity, very high cost wells, and some of the California huff and puff, again, inefficient type stuff. And so in the U.S., I would expect you'll see shutdowns in some of those wells before this momentum in the shale comes to light. The other thing is there are a lot of places overseas. And my question to the other panelists is that sort of the geopolitical elasticity of oil prices and oil supply, I think particularly of Nigeria, losing the excess crude fund and having an election and having a completely glutted sweet oil market in the Atlantic Basin leads me to believe that where you're going to see cuts in supply is from Nigeria. Yeah, Venezuela is as badly as it's doing can certainly do worse, and I think there are other examples as well. And the credit problem that we talked about in Russia from Steve is another place where we might see lower oil supply. So I'd like your reaction. Thank you.
Questions, David's and anyone jump in.
Stab at both, and then I'll pass it over. David is absolutely right, and the reason that I phrased things the way I did is because the logical economic actor approach and outlook for 2015 is most likely the one that's going to be wrong, right? For exactly the reasons that you mentioned. For what it's worth, we do include massively accelerating decline rates in existing fields as operational budgets get squeezed. As for the U.S. universe of E&P actors and their hedging programs, the short answer would be that they've hedged too little, right, obviously. And Mr. Ham, who sold his hedges before the OPEC meeting, may be regretting that decision. It's typical, there's nothing news about this. When prices collapse like this, they will always have hedged too little. They've hedged some, and for some the pain will be less. They will continue to drill that little bit more than some of the other ones that are unhedged. Simple.
Anyone else on either of these? Yep.
Yeah, I mean, I love the Nigeria one because if you asked me if I'm looking to 2015, which OPEC country may cut by accident, it would literally be Nigeria. I mean, Nigeria is a historic free rider. I mean, I think the Saudis just have not even gotten over sort of 86. Like I was looking at the Prince Turki statement where he's singling out Russia, Mexico, and Nigeria, not wanting, sort of the bad actors who also potentially need to cut. And the thing about Nigeria is that this is the one place where we see when you have civil unrest, it actually leads to production outages, and typically around elections. I mean, what they do because of state governors, I mean, if you're a governor of River State or Bayelsa State, you get 13% of all the oil revenue before it goes back into redistribution across 36. So you're like the richest person besides the president of Nigeria or like Aliko Dangote. So you don't want to lose office because you lose immunity and you lose access to the revenue. And so they import massive amounts of weapons. And so we saw, for example, I was a CIA analyst in 2003. It was my worst moment where these rival political gangs were fighting outside of Chevron's Escravos facility. One gang ran on, the other one followed them. They were like, whoa, this is a great place to sort of loot. And so we had Chevron's facility shut down. And so in a matter of days, we lost 800,000 barrels of production simply because of elected-related unrest. And so at any given election, they increase crude theft, and that has a knock-on effect for production because people always think, well, it's stolen, it still gets to the market, but not when they damage the pipeline, you have an increase in force majeures. And so that's a normal Nigerian election. You lose a couple 100,000 because of damage to infrastructure. Where this election sort of worries me is what happens when you have massive amounts of weapons. And I would tell everyone to read the International Crisis Group report on Nigeria and the elections. It's a terrifying document. But what happens when you import a ton of weapons and there's no money to glue that patronage machine together? And so I think, gosh, you could literally see a situation where you have more sort of knock-on political violence in the oil region, and you could have, more pipelines damaged, sort of collateral damage, but you could see Nigerian production coming off because of the broader political and security challenges. So that's like the first country I would say where literally you could see a spillover onto production because of the broader problems of low oil prices.
Yeah, go ahead.
Just a quick comment. You're absolutely right about the impact of sanctions on investment for long-term energy projects. It isn't just a question of bailing out corporations that are having, bottom line refinancing problems in the short term. Those, across the board, investment projects of that kind with Russian partners are kind of on hold. That won't have an impact on production in the short term. And as Helima says, the Russians have always been, what was your term, bad actors, when it comes to playing along with OPEC strategy. They aren't a member of OPEC for a reason. But in the medium term, the impact of that kind of credit crunch will be real.
Discriminating against people watching online, and we have several questions from Twitter. So let me two that are kind of related. One is how does the decline in oil prices affect natural gas supply, demand, price, and then one about what the decline in price may mean for investment and development of shale resources in Argentina.
natural gas is, we can be very brief about that. There is too much natural gas. The price for natural gas is not going to go up. Was not going to go up unless we have another extreme winter, and even then it would have gone up till about March 23, right? Natural gas prices were going to be down. They are going to be more down now, with still more technology and still more drilling to come. There is no tightness in natural gas looming from the moment that eventually maybe some producers will produce less of it. Gas still works for the guys that produce it. They'll produce more of it. No impact.
In terms of the Argentina question, I suppose that under normal circumstances, you would imagine that the marginal shale fields, the Argentine shale fields would be amongst those, and therefore you would see a reduction in investments in some of those projects. The infrastructure is not quite there. The cost on the, for setting up these investments is much more significant than in the U.S., so you would imagine that those segments would be curtailed. But Argentina is far from a market economy. The price is not coming down domestically. They are keeping the domestic price for oil up, and therefore the new producers are probably going to be rewarded by in the short term by the current framework. So I don't expect to see a major change in the efforts in 2015. Though on the margin, I think if anybody has a choice of delaying investments for a little while, they'll do that. But I think that the few projects that are still underway will probably continue to be explored and invested on in 2015. The question in Argentina is much bigger down the road when we see an opening up of the sector. And at that point, I think the oil prices that will be critical, and the technology will also be an important factor. But I think we're still at least a year away from being in that environment.
Jason, one sentence on gas is a reminder that one of the American goals announced in the Ukraine crisis is to work with Europe on reducing energy dependence on Russia. And those words were spoken by Kerry 6 months ago. I don't know how that effort plays out in the context of different price environments, but it seems to me that's a big geopolitical issue that we haven't really taken up here and probably should keep our eye on for the future.
We'll take. Did you have? Okay, we'll take. Question up here. Probably have time for just one, maybe two more questions if we keep it brief.
If I can make a comment on that, it's actually virtually whole Eastern Europe and Ukraine has been connected through connectors with Germany. And therefore, the gas that is flowing to Germany through Nord Stream is being sold down the line as it's needed. And this is the security that they have right now. But my other comment was also on Russia, and it has to do with that I think that there are many, many more pressures on Russia than what you talked about. You talked about the main pressures, but there are also pressures such as that the areas that these Russian separatists have occupied are now completely denuded of people. There are waves of refugees going to Western Ukraine and Poland. And they need to subsidize these areas. So they need money. They need money for electricity, for food. There's nothing there. It's like a wasteland. Another thing is that Donbass, Donetsk, is actually the most industrialized area of Ukraine, but with heavy industry. But most of the products were sold to Russia. So actually both countries lost on the really destruction of this area, and it will be very hard to rebuild. So this is another pressure on Russia. You were talking about lack of investment. The current production is declining in Russia. They had these deals with Western companies to expand, and they are not doing it now. And I actually attended a conference on Sunday at Yale, and they were talking about that most of the support for Putin has to do with the better economic situation, and there is really no great support for this very aggressive foreign policy. And there is actually talk of a coup d'etat in Moscow against Putin. What would happen to the oil price if something like that happened?
Your neighbor has told you it's foolish to predict oil prices.
Black swan scenarios, go for it. I don't have an answer to that. Russia will continue to export energy if Putin loses power. What you say about what Russian policy has done in Ukraine, it reminds me of Trotsky's proposal in World War I to pursue a policy of neither war nor peace. And it turned out to be a real disaster for everybody. Both the Ukrainian and Russian governments are pursuing a policy in Ukraine of neither war nor peace, and it's a disaster for everybody. Eventually, Lenin stepped in and solved the problem and imposed peace in Brest-Litovsk, in which the conflict was ended. And that's what Putin has not yet been prepared to do. Hadn't thought of it this way, but Putin is pursuing a Trotskyist policy in Ukraine.
So we're just about out of time, but does anyone have any closing tweets, 140-character comments you want to make very quickly before we wrap up? Okay. This has been a really interesting discussion, very timely, and appreciate everyone coming out in terrible weather and the many who are watching online as well. And please join me in thanking a really fantastic panel.